Situation 1. Futura Company purchases 79,000 starters that it installs in its standard line of farm tractors from a supplier for the price of $13.70 per unit. So I'm just going to put that 79,000 right here because I know that's going to be important later. And they purchase from a supplier for $13.70. So purchasing it from a supplier for $13.70. So I'm just going to put that right there. That's my buy, my purchase. Okay, so due to a reduction in output, the company now has idle capacity that could be used to produce the starters rather than buying them from an outside suppliers. However, the company's chief engineer is opposed to making the starters because the production cost is $14.80 as shown below. So this is information that they're giving me about what they think it would cost to make the starters. If Futura decides to make the starters, a supervisor would have to be hired at a salary of $134,300. So that's that number there to oversee production. However, the company has sufficient idle tools and machinery such that no new equipment would have to be purchased. The rent charge right here above is based on space utilized in the plant. The total rent on the plant is $87,000 per period. So right there, that tells me that this is a portion of a fixed cost for rent that is not going to change whether we make it or whether we buy it. We still have to pay rent. And depreciation is due to obsolescence rather than wear and tear. That just means the depreciation is due to the machinery becoming obsolete, or it's like a technology thing. It becomes obsolete rather than wearing out. But again, depreciation, it's not a money transaction that's on the books. And so that is also a fixed cost that when we're talking about make or buy decisions, we do not take that into consideration. Okay, so what is the financial advantage or disadvantage of making the 79,000 starters instead of buying them from an outside supplier? Okay, so buying them, let's see, I should probably put total here. Right? Yeah. Equals 1370 times 79,000. Okay, but what would it cost me to make them? And I just want to look at relevant costs. And so direct materials, that is relevant. So $7 times 79,000 units. Direct labor, that is a relevant cost. So it's $3.50 times 79,000 units. The supervisor's salary, that is relevant because he would have to be hired if we're making them. And so that is going to be equal to his salary. Variable manufacturing overhead, that's a variable cost, so that is relevant. $1.30 times 79,000 units. Wait a minute, is there something different? Oh, whoops, I picked the wrong one. You guys should yell at me. So I accidentally picked depreciation, and that is not, we do not take into account depreciation because, as I said, that is a fixed thing and it's actually not a transaction. It's something we put on books. I should have selected the 70 cents for variable manufacturing overhead. So that is the correct total there. Sorry about that. And that is it. We don't need to take into consideration rent or depreciation because they are fixed. They're sunk, as in depreciation's instance. And rent, that's going to happen whether we make or buy. So it's not relevant to this decision. And so our total there is going to be the sum of all of these costs that we just came up with. Okay, so now if we look, so this is, it costs us more to buy them than to make them if we only take into consideration the relevant costs. And so this is a financial advantage, right? Because this is less. We always like to choose things that are going to cost less when we're talking about costs. And so to find out the total financial advantage, I'm going to take the buy minus the make and get the difference. So for mine, the financial advantage is $63,200. Okay, on to question 2. On Products manufactures 35,000 units of part S6 each year for use on its production line. At this level of activity, the cost per unit for part S6 is this. So they use 35,000 units to make these numbers. So then they gave me my direct materials, direct labor, all of the costs. Okay. An outside supplier has offered to sell 35,000 units of part S6 each year to Han Products for $23 per part. Okay, so that is a buy, right? Purchase price. I'm going to put that right there so I don't lose it. $23. And I'm going to put my units right here, right? 35,000 units. Okay. If Han Products accepts this offer, the facilities now being used to manufacture part S6 could be rented to another company at an annual rental of $85,000. Okay. Rent of idle space, 85,000. Okay, that's important. However, Han Products has determined that 2/3 of the fixed manufacturing overhead being applied, the part S6 would continue, even if part S6 were purchased from the outside supplier. So that means in our decision, we need to include 1/3 that would go away, right? The 2/3 stay, then 1/3 goes away. So 1/3 of the fixed manufacturing. So I'm going to put that in before I forget. So it's going to be equal to the fixed manufacturing overhead per unit times the units. And I should have put that in parentheses because I want that to happen first. And then for me, and number wise, this is how you got to do it to make it work out. You divide it by 3, and that will give me 1/3. So for mine, 105,000 is 1/3. So again, for the fixed manufacturing overhead, because they tell us 1/3 of it is part of our decision-making process. So again, that's the fixed manufacturing overhead per unit times the units divided by 3 to get 1/3. Okay. Where were we at? Okay, what is the financial advantage or disadvantage of accepting the outside supplier's offer? Okay, and I'll show you why we put this over here in just a second. And I actually put that in the wrong place. So I want to put my total right there. So $23 per unit is my purchase price. Okay, so my total purchase price is going to be that 35,000 units times the purchase price. Okay. So in this, we're going to get revenue of 85,000 and then this expense and this expense if we buy. So we're going to take the 85,000 minus the 105,000 minus the purchase price. What? Look right. I did it backwards. Okay, let's try that again. So ignore what I just told you. This is going to be equal to. So this is our purchase price. This is an expense that's going to go away. So we subtract that. And this is a revenue. So we subtract that from the expense because it's opposing. Oh, that's not right. Excuse me. And so we come up with a final cost of 615,000. Okay, again, that's because here's our purchase price. This is an expense that's going to go away, and this is the revenue we'll get from renting the idle place. So that counteracts part of our purchase price. And so that's why our total cost for buying is going to be this. Okay, now making it. We're again going to take our direct materials because that's part of it times the 35,000 units, and then our direct labor per unit times the units. Oops. And then our variable manufacturing overhead times the units. Okay, so that is all that we need to consider in the make side because the rent of the idle space was only if we buy it. The fixed manufacturing overhead, that's fixed. And then the purchase price was for the buy. And so we add up those relevant costs in our decision-making process. And we come up with 630,000 if we make it. So what was the question? What is the financial advantage or disadvantage of accepting the outside supplier's offer? Well, it's lower, so it is a financial advantage. And we just take the difference of those two numbers to find out how much of an advantage it is. So for mine, it's an advantage of $15,000. Okay, question 3. Looks like a bear, but it's really okay. There's just lots of choices here. So we're getting into a conversation here. In my opinion, we ought to stop making our own drums and accept the outside supplier's offer, said managing director of Antilles Refining, Nevada of Aruba. At a price of $20 per drum, we would be paying $4.25 less than it costs us to manufacture the drums in our own plant. Since we use 75,000 drums a year, that would be an annual cost savings of $318,750. Antilles Refining's current cost to manufacture one drum is given below, and this is based on 75,000 drums per year. So they give us all of this information. A decision about whether to make or buy the drums is especially important at this time because the equipment being used to make the drums is completely worn out and must be replaced. And so the company is facing the following choices. Alternative 1, rent new equipment and continue to make the drums. The equipment would be rented for $225,000 per year. Alternative 2, purchase the drums from an outside supplier at $20 per drum. The new equipment would be more efficient than the equipment that Antilles Refining has been using according to the manufacturer and would reduce direct labor and variable overhead costs by 25%. So that's important. Whatever percent your problem says, I'm going to want to mark that down somewhere. The old equipment has no resale value. Supervision costs $75,000 per year, and direct materials cost per drum would not be affected by the new equipment. The new equipment's capacity would be 125,000 drums per year. The company's total general company overhead would be unaffected by this decision. Okay, so we're going to do 3 requires. First, we're going to assume 75,000 drums were needed each year, and then we're going to assume 93,750, and then we're going to assume 125,000 and find the financial advantage or disadvantage for each case. There's my typo. It should say for all requirements, enter any disadvantages as a negative value. Do not round intermediate calculations. That means as you're doing the math, don't round any of the numbers until you get to the end, and do not leave any cells blank. All of those are very important instructions. Okay, so first, what's our supervision cost? That was 75,000 per year. So I'm going to put that right here. Okay, and the rent of the equipment for alternative 1 was $225,000. Okay. So now I'm gonna do this 3 times. I'm gonna do it for each number of units so I can reference those units. So direct materials for making would be equal to the number they gave me up here, direct materials times, in this case, I'm working on the 75,000. Oh, I got a better idea. I'm going to just bring down the per unit. But if you'll recall, where did it tell me that? Right here. The new equipment would be more efficient, and so it was going to reduce direct labor and variable overhead costs by 25%. Okay, so I need to do, okay, one way I can do this is say equals direct labor minus direct labor times 0.25 for 25%. Okay, so now it's $4.50 per unit instead of $6 per unit. Or I can also go equals variable overhead times 1 minus 25%. Whoops. Minus 0.25. Let's see if I get the right answer. And so now it's $1.20 instead of $1.60. So let's look at those formulas again. This one, I took the per unit variable labor minus parentheses, the per unit variable labor times 25%, right? Because in my parentheses, then I'll get 25% of that, and then I'm reducing my original cost by 25%. And this one, 1 minus 0.25 is 0.75, which is what's left. And so if I do my original cost times parentheses 1 minus the percent, close parentheses, then I also get the correct answer. So there's 2 ways to get the correct answer there. Okay. Fixed supervision See, right there. So that fixed supervision is $1. The rent of the equipment. Hmm. This is a fixed expense. And so I'm just trying to get my per unit stuff here. And so this is going to equal to the rent of the equipment divided by the number of units. Okay. And so those are the things that if I'm making it, those are the expenses or the costs that I need to consider. So I'm going to sum those up. And that's how much it would cost me to make them per unit. And per unit, remember, if I was buying them, purchase the drums from an outside supplier at $20 per drum. So that's my alternative two. And so that was $20. Okay. So now to get the total cost, I take my per unit times the number of units. And then again, per unit times the number of units. And then this is my financial advantage or disadvantage of, what was it? Buying. So there, we're checking to see if buying is more or less than, and that's how we'll know if it's a financial advantage or disadvantage. So I took making minus buying equals 60,000. Right? So that's an advantage because making that costs 60,000 more than buying. So buying is a $60,000 advantage for 75,000 drums. Okay. So I'm going to do the same thing, only I'm going to stop scrolling so far and I'm going to just copy down these numbers. Oops, not that far. For making, buying is still that $20, but now I'm looking at 93,750. And so that's going to be $20.80 times 93,750. And I'm going to drag that over. Oops, it didn't like that. Equals this times this. It's because I forgot to anchor the cell. That didn't work out right. Oh, I see why. I have my supervision cost is wrong because there is a different number of units. And so my supervision cost is 75,000 divided by the new number of units. And the rent of equipment is also going to be different. It's going to be the rent of the equipment divided by the new number of units. And then this is going to equal the sum of these numbers. Really important to do things right or you get all the numbers wrong. Okay, there we go. So for this instance, making it and buying it is exactly the same cost. And so it's 0. So make sure when you enter this in the book, you put in 0. Otherwise, if you leave it blank, it'll get marked wrong. So put in 0. Okay. So now we're going to do the same thing, only we're going to do it right this time for 125,000 units. So this one and this one I can drag down. But this one I need to go equals that's supervision cost divided by the number of units. And then this equals the rent of equipment divided by the number of units. And then I'm going to add those up. Whoops. I'm going to add those up. And this is again still that same $20. So this equals $19.20 times 125,000 units. And this equals $20 times 125,000 units. And that becomes a disadvantage, right? Because it came out negative. Making minus buying equals negative 100,000. So make sure that you put negative 100, put a negative in front of your answer when you enter this one into the books. Okay, that's question 3. Question 4. Imperial Jewelers manufactures and sells a gold bracelet for $400. The company's accounting system says that the unit product cost for this bracelet is $261 as shown below. And they give us all of the individual and then they add it together for us. The members of a wedding party have approached Imperial Jewelers about buying 22 of these gold bracelets. So that's important. So my special order is 22 units. For a discounted price of $360 each. So per unit, it's going to be $360 is what they want to pay. The members of the wedding party would like special filigree applied to the bracelets that would increase the direct materials cost by $6. So that's going to be equals, let's see, there's my direct materials. And here's my filigree for $6 more. Okay, what else are they telling me? Imperial Jewelers would also have to buy a special tool for $455. So a special tool has got to be added here. Okay. This special tool would have no other use once the special order is completed. That stinks. To analyze the special order opportunity, Imperial Jewelers has determined that most of its manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. So that means we're just going to take into account the variable costs. However, $7 of the overhead is variable with respect to the number of bracelets produced. So the variable factory overhead is 7 because that's how much is variable. The rest of it is fixed and we don't have to worry about it. The company also believes that accepting this order would have no effect on its ability to produce and sell jewelry to other customers. Furthermore, the company could fulfill the wedding party's order using its existing manufacturing capacity. That just means that other than that special tool, they don't have to buy any other capacity, and it's not going to affect any of their current orders. And so all we have to take into consideration is if this special order will still make us money. So they want to know, what is the financial advantage or disadvantage of accepting the special order from the wedding party? So the only thing I am missing from here is my direct labor, because everything else I filled in as I read that paragraph, so I wouldn't lose the numbers. So we don't have to worry about the fixed. So my unit cost is going to be that's not what I wanted to do. Holy cow. Oh, okay. So let's work on some totals here. Our total sales for 22 bracelets times $360 a piece will equal that. And since I already added all those up into my unit cost, I'm just going to multiply my per unit cost times my 22 units. Okay, and then I have my special tools. So these are the numbers I need to work with. And so to figure out if there was a advantage, or if we made money, that would be an advantage, right? So we're going to equals, so the total sales minus the total cost minus the special tools equals 2,185. And so that is an advantage because it's a positive number. If it had been negative, it would have been disadvantage, but it is an advantage of $2,185. And so, yes, as a company, they would want to accept this special order because it made them money. It might not have made them as much money as if they would have sold at their normal selling price, but it still made money. And so, yes, they're going to do it. Okay, question 5. Okay, Delta Company produces a single product. The cost of producing and selling a single unit of this product at the company's normal activity level of 100,800 units per year is all of this. Okay, the normal selling price is $21 per unit. The company's capacity is 114,000 units per year. An order has been received from a mail order house for 1,100 units. Okay, special order 100 or 1,100 units. And they want at a special price of $18 per unit. So that's our selling price per unit for our special order. This order would not affect regular sales or the company's total fixed cost. So again, up here, we're not going to have to worry about anything that's fixed. We're just going to look at variable to find the financial advantage or disadvantage of accepting the special order. Okay, so our variable costs are direct materials, direct labor, variable manufacturing overhead, variable selling and administrative, and then we'll add those up to get our variable cost per unit. And so our contribution margin per unit is going to be the selling price per unit minus the variable cost per unit, right? That's how we get contribution margin per unit. And so because, where did it say it? It said, this order would not affect regular sales or the company's total fixed costs. So all we need to consider is our contribution margin per unit on this special order. And so this is going to be advantage because they are making money per unit. And so the number would be that contribution margin per unit times the number of units. And so my advantage is 11,330. Um, yeah, hopefully that helps. Just remember your numbers are probably different than mine, but the process should be the same. Good luck.